What's up, everybody? This is the Excel dude coming at you again. Today we're going to do option basics in Excel. We're going to talk about call options, put options, just the basic modeling of those, what goes into the price, how you would calculate it in theory. We're not going to use actual market data right now because this is not financial advice. This is a hypothetical example. Do not use this as any kind of recommendation, anything like that. I do not need to go to jail. I'm just showing you how to click some keys and make it show up in a graph here. What's up? You've been liking the content? Click on that can't stop, won't stop kitty. Should be right down that way. He's got those fancy threads there, and that's how we keep him all decked out. Anyway, we've got our spreadsheet. There's several things we have an option. There's two kinds. You got your call. That means you're betting that the price is going to go up. You have your put, which means you're betting the price is going to go down. There's a price you have to pay to get those contracts. It is a contract. You're not trading in the actual shares. You're buying a contract based on what the shares do. So it is a derivative instrument. It is not a stock. It is a different beast entirely. So understand that there's a lot of complexity in here that we're not even going to touch on. So before you get into these, you really should at least watch a few other people on YouTube. Don't take my word for it. I don't need to be going to jail. Anywho, let's say we're going to bet the price goes up. We have a call option. And let's say we're going to bet on can't stop, won't stop GameStop. The one we saw today jump $100 and it is up more after hours. This is just a wild ride and I am loving every bit of it. I would not recommend in, out, anything about that stock. I'm just saying this is a fun time and make some popcorn. So you've got your share price. This was at the close, $91.71. The option price at the close was for the ask. So when you're buying something, you will pay the ask. When it says bid and ask, the ask price is what you will pay. It will be the higher one. And then if you want to sell something, you will receive the bid. That is the difference, the lower amount. So the difference between that, the dealer's spread, that is what the dealer makes. The dealer is essentially a bookie. Watch, it's one of my favorite Christmas movies, Trading Places. Yeah, Eddie Murphy and Dan Aykroyd, I believe. It's awesome. It's fantastic, and yeah, Valentine figures out exactly what a stockbroker is. It's a bookie. They're no different than these guys on the strip down the way. All right. So we have an option price. That's what we would get if we sold it. And again, these are American options. That's all we're going to talk about. You can enter into them anytime before the expiration. You can exercise anytime before then as well. We won't get into Europeans or Bermudans or anything like that. You have a multiplier. You can't just buy one option on one stock. They typically sell them in lots of 100. So this 17 cents is really more, or this 22 cents that you have to pay on the ask for buying it, is really times 100. And the 22 cents is really $22. But you have the upside on 100 shares, not one share. So it's just you can't do one share just like you would with the normal stock purchase. It's definitely not the equity market. So you have a strike price here. Let's say you're betting that, let's say you did this 3, 4, 5 days ago. You're saying it's going to go above $100. I know it. And it's going to do it by Friday because you have to pick expiration dates. And if the price is above your strike price that you purchased at, you'll make the difference there. That's awesome. Or you can purchase the stock at a discount if you want to take possession of it. You'll need to have the cash in your account though. So the expiration date, let's say it's this Friday, 26th. You have 2 days to expiry. So you're paying $22 to bet that this thing would go up $9, which it's like what, 8-7% move? That's a good move. That's a strong conviction bet. That is essentially, I would liken it to a parlay if you're at the book or the sports book. And all right, you got your 22 in there. You have that. And these are the Greeks, as they call them. There is delta, gamma, theta, vega, and rho. Now there's some other derivatives and variants of that, but these are the primary ones, or at least the basic ones. Delta is the rate of change. So think of it like that. Right here, it is every dollar that underlying price moves. So every dollar GameStop stock goes up or down, that's going to be the amount of, let's say delta is this, 0.9570. Every dollar GameStop goes up, the option price will go up 0.9570. Now, the delta will change. That depends on how high or low the stock is in relation to the strike price. That's gamma. Gamma is the rate of change of the rate of change. Derivative of a derivative almost. It's definitely a little more complex than, actually it's a lot more complex than that, but that's a decent way to summarize it. Theta is your time. So T, time, hammer time. So theta, all that is how much time you have left until expiration. And the longer you have, so let's say you got an option that lasted 3 months instead of the 2 days on this example, your theta would be higher and you would pay that in the premium because you're not going to get that, like nothing's free. You're compensating someone for the risk they're taking during that time. If it's 2 days of risk, here it's 0.0212. If it's 2 months of risk, it might be, who knows, 60, 80 times that. You never know. And these all fluctuate and everything. Vega is a proxy for volatility, basically how much the stock could move up or down. And then there is, well, it's based on historical average. And then you have rho. Rho is based on an interest rate derivative, so a function of risk-free interest rate. And then this one, I'm not going to go into this one very much, but implied volatility, it is a critical input in pricing options and seeing what the market is. So before you even start trading these, you better know what implied volatility is. So you got a little homework there. Puts, the inputs are the same. All you're doing is betting the stock's going to go down. The differences are, you see gamma here, it's negative. So that means when the price goes down, you will make money. Puts have a delta that is negative, and they can go all the way to -1. And calls are the opposite. They go positive, +1. And 0 being the limit on each of those. So you have your two options here, expiration date, 2 days. How much money could we make on this? Let's say, hey, I got 20 bucks, or I got 22 bucks. Let's go slap it down. Let's see what happens. Okay. So we're going to unhide all of these. And these are the payoff profiles. So this is your long call. You've put $22 down. You're betting that this price is going to go above 100 bucks by Friday. All right. Let's say it's Friday. It expires, or it's expiry day. You can either take delivery of the shares if they're in the money, which let's say it did go above that. Say it went to 110 bucks, and you spent $22. So you bet that $22 it'd be above 100. It went to 110. Great. So you're going to make $10 per share, 10 times 100, minus your original premium. There you go. 978 bucks. You just turned 20 bucks into almost 1,000 in 2 days. That's what you can do with options. However, it's far more likely that it doesn't end in the money and you just lose your 22 bucks. Options portfolios are very often characterized by a large number of small losses and a small number of larger gains. So if you can be right, yeah, it's like if you're a professional gambler. You can hit 54, beat the spread, or 50, excuse me, 54%. You're not doing too bad. All right, now let's go to a put. Well, so here, this is the call option diagram. I lied. Everything, here's your negative $22. This would be your profit in dollar amounts, just for scale. And here's what it is at each level. So at $110, you'd be at this 978, which is right here. Right here, anything below $100 on that strike price. If it's Friday, options expire, market's closed. Below 100 bucks, you lose all $22. So you are at negative 22. But as it moves up, you see that these profits continue to scale. So this thing right here, it's only gone up 10 bucks more than you thought it would, which granted it's still a move huge in percentage terms, but it happens. And I mean, gosh, if you'd done this on Tuesday with GameStop, it'd be a nice weekend, that's for sure. So you can see the payoff profile is fairly linear. Goes here, it follows the payoff profile of the Greeks. The put option is the same thing, it's just opposite. All we're doing is betting the price goes down. So on this, you see, now a put option is a little different because with the call option, the price can go to infinity theoretically. So if it goes to $1 million bucks, yeah, you're making everything between $100 and $1 million. That's unlikely to happen, but you still have that upside. It's unlimited. With a put, a stock can't go below 0. So if it's at 100 bucks, the most you can make on this is 100 bucks minus whatever you paid. So this would be, let's see, $100, yeah. And you have your maximum payoff here. Yes, so this is where the price is above 100 still. and you're betting it's going to go below 100. So we're just taking the opposite side of that bet. And this we'll get into in a moment. But right here, price is at 110. Okay, you've lost $17 because let's say that was back to this. The ask price, you pay that when you buy it. And here, actually, you'll do the ask price as well. Yeah. Whoops. There we go. Looks like I messed up there. All right. Yes, we're not selling. We are buying. There we go. Okay. Still works. So you bet your 22 bucks the opposite way. It's going to be below 100. Just fine. It's at 110. You have lost $22. At 105, you've lost 22. Same thing at 100. There's no value in that option. Like, no one's going to sell you the thing for less than they could. It just would not be exercised ever, or you wouldn't exercise it. And what else do we have? Yeah, so you go down here, and it's at 95. You're making $5 a share. Okay, so you have 5 times 100 minus your 22, 478. Then it goes to 90, making $10 a share. Great. So you've got 10 each share times 100, 1,000 minus that 22. And let's say it's catastrophic. This thing goes nuts. There's accounting fraud. It's Enron 2.0 or 4.0, whatever we're on now. And you go to $15 a share from 110. Man, you only paid 22 bucks for that. Well, you just made yourself $8,400. Now, again, predicting a bankruptcy with 2 days to go is, you're not going to do it. You're not that good. I don't care who you are. But it's something that can happen. So you can just see how the leverage in these options, or you can, with a fairly small investment, like 22 bucks, you can really hit some home runs on these. But just looking back in the GameStop, let's take a look at, say, Melvin Capital. Like, you can see how they would bet, yeah, it's at $20 and it's going down, $18 a share. And they use leverage. So with margin, I believe margin requirements in the US are, what, 50%, something like that? I don't recall. But that's roughly 2 to 1. So you can double your stuff up. So you put down cash for half of it, and then you use margin to purchase the rest. So you've borrowed essentially the other funds. So you're paying interest on it, whatever, there's other costs. But you're here, you take your profit, and it's going to double it. So let's say the same thing happens. It goes from 110 all the way down to 15 bucks, and you're using margin. You are levering up just like, say, a Melvin Capital or whomever else did it. You click down. You just made, off your initial $22 investment, 17 grand, 2 days. Not bad. But good luck predicting that. Good luck. If you can, you're going to be the world's first trillionaire. Might get lucky once in a while, but still. And now we'll look at another example. Actually, you know what? Before we even go to the calls, we're going to talk about this. Right here, this is the price of a put option, the one that we had at $22, assuming it was the same as the call option. Right now in the market, that implied volatility we talked about, it is so high, people think this is going to change so much. Whether it's up, down, nobody knows. It doesn't matter. The stock is just moving. That moves implied volatility. So that's going to volatility as well. But you're going to have a lot of different price action. And after that, if you went to go buy that in the after hours, that single put option is going to be $54.70. And these shares were trading at something like, I think it was $154.50, roughly around there, 154 bucks. So to make money on this at 54, so if you paid $54 for that put option, even if you're like, oh, this thing is going to crash, it's going way down, okay, it is going to require almost $100 of movement to the downside. That's almost 67% of the stock price to break even. That's astronomical. You don't do a trade like that. You deserve to lose your money if you do something like that. That's, well, maybe not that, but that's bad. Gosh, it'd be like betting on, I don't know, an infant stopping on the goal line, Herschel Walker. It's possible he could trip. He might have a heart attack. He's getting there. So let's look at if you were to buy call options versus shares. You've got 2,000 bucks. You're like, hey, maybe I'll buy some shares in GameStop. Okay, I can get, you know, a couple of here, a couple of this stock, a couple of that. Yeah, we'll do it. We'll see them move up. We'll make some money, hopefully. Anyway, you've done your due diligence, you like the stock, all that nonsense. So you go here and you're going to lever up. So you've used your $2,000 and you've taken every single one of these call options you can get, and you just spent $2,000 on these $22 call options. So you have a lot of different, let's see, what is our number there? Equals 2,000 divided by 22. So yeah, assuming there were no commissions, which is never the case, you would have 90 call option contracts for 100 shares. So times 100. Yeah, so essentially you would have upside on almost 9,100 shares. That's a lot of upside. So let's say this thing keeps moving, it keeps going. Let's say it goes to 110. You bought $2,000 in call options, which is definitely a YOLO bet. Like that's 2 days, you either have a bunch of money or you lost $2,000. Oof. Anyway, you could turn that $2,000 into 88 grand right there. And that's pre-tax. The government's going to come in and take, what, depending on what state you are, probably close to half, but regardless, you can turn $2,000 into 88 grand or almost 89, or if you're using margin, stuff like that, less leverage, you can turn it into 17 stuff. So you can make relatively small bets and make a lot of money. The only difference is if that price moves against you, options limit your downside, and just like you see right here, profit doesn't matter what the price goes. This could go to $1 million, or this could go to $1 million in this put, and it doesn't matter. You've still only lost your initial $22 investment. It's okay. I mean, you'll survive on that. But if you sold these, you would collect your $22, and let's say it goes to zero, you still have to. You're on the hook for all the difference there. So selling options, very dangerous. Call options or long options is still dangerous, but it's fun. And just like the initial card said right here, what are we going to do? Hedge risk. Maybe you own shares and you want to, let's say you want to protect from the downside. You buy some put options on your stock that's at 100. You say, okay, let me have them at 90. They're cheap. If the stock tanks and goes to zero, you still keep $90 of that. That's a good risk hedge. If you have to be safe for a certain amount of time, it can be useful. There's a time and a place for everything. However, you can also do the YOLO bets and gamble like a degenerate. So it's up to you. Hopefully this taught you a little bit about it and how you can model it in Excel here, how you can get your graphs. I mean, this is a basic graph. You just go insert right there. And that's it. If you'd like and subscribe, I would appreciate it. Help it get out to more people. And I'll see you next time. Thanks.